Hey folks, we're polishing off Chapter 3 this week with some pretty important topics. Because adjusting entries never involve the cash account, they do not affect cash flow. But adjusting entries are necessary for the accurate measurement of performance, like profitability. However, good judgment must be exercised in the preparation of adjusting entries to avoid the abuse and misrepresentation that can occur. Remember the discussion about ethics in earlier chapters and Enron. I would also add that good judgment ought to be based on a solid worldview, a biblical worldview. You'll never go wrong if your good judgment in making adjusting entries is based on honesty as described by the Bible. And speaking of standards, such standards, biblical standards, are necessary when considering the manipulation of earnings or revenue and the management of that. Earnings management is the manipulation of revenues and expenses to achieve a specific outcome. Earnings management within a small range of manipulation is not illegal. In other words, a little bit of moving the numbers around is expected, because sometimes accruals of revenues and expenses is not an exact science. It's a judgment call. But earnings management with a liberal or broad scope judgment call, if you will, can mislead the users of accounting reports and can constitute fraudulent financial reporting. And again, remember Enron when they used what they call it, the mark-to-market earnings management strategy to significantly overinflate the company's profitability. And they used this strategy to fool investors into buying more stock. Now, over the years, most SEC violation investigations have stemmed from misapplication of the matching rule. We learned about the matching rule back, I think it was in Chapter 2. Misapplication of that matching rule results from improper accrual accounting. Unfortunately, some companies take great liberties in their earnings and management strategy, and it gets them into trouble. So let's talk about liquidity for a moment. Accrual accounting helps management assess profitability, but a cash flow analysis helps management measure liquidity, how much cash you have on hand, and forecast cash requirements as well. Instead of keeping, two sets of books, one to measure profitability and one for liquidity, accountants convert accrual-based numbers to cash-based numbers. These cash-based numbers are called cash flow measurements. Cash flows can be determined by analyzing the relationship between the income statement and the balance sheet accounts. In general, cash flows can be measured by determining the maximum possible amount of cash payments for each expense or revenue, and then subtracting out the amount that's not paid or received. Check out Exhibit 10 in Chapter 3. There are 4 different scenarios that we are reviewing for now about assessing cash flow. There's the prepaid expense scenario, there's the unearned revenue scenario, there's the accrued payables scenario, and then finally there's the accrued receivables scenario. And again, check those out in Exhibit 10 in Chapter 3. All right, that's it for now. Please read Section 9 of Chapter 3 to understand the details of ethics, liquidity, and cash flow. And remember, God is on his throne. He's always been there, and he's always going to be. Have a great day.